Parts of the reason why crypto and Bitcoin is so controversial is because it does not produce anything. It's not an income producing asset like stocks with dividends or like property with rental income. It simply sits there and people wait for the greater fool. Warren Buffett, for example, once called Bitcoin red poison squared. And it is harder to value Bitcoin because if you don't have any cash flows to discount to the present, then how can we really say if Bitcoin is worth $10,000, $100,000 or even $1 million? It is true that Bitcoin's price long term is going up because larger and larger wallets buy it, because more and more investors get into it. But if that's the major force behind Bitcoin's price appreciation, how can we see what a realistic anchor point is? There is a macro anchor point and a micro anchor point. We're looking at the macro first. This is a long-term Bitcoin price chart, and what we see in orange is the realized price. So this is the average cost basis of the market. The current price is simply just what Bitcoin traded for today. The realized price looks at all of the Bitcoin that have ever moved hands and at what price did that Bitcoin move hands. So you can see what's the average cost basis, what's the reference price. If the current price is above the realized price, on average, the market participants are in profit. If the current price is below the realized price, it means on average, people are currently in losses. So this is a very useful anchor point. Because think about this, how you behave in the market. If you think that Bitcoin very long term goes up because the supply is limited, but fiat currency is not, then what do you do when currently the price is below your individual purchase price? So let's just assume that you bought exactly for the realized price. You are the average market participant. If you're currently in losses, you might just wait it out. You might just wait until the price recovers again. And since this psychological effect is so strong, we tend to see the end of a bear market whenever the price is below that realized price. The selling pressure declines and people that haven't yet allocated to Bitcoin start buying the dip. Now the opposite is true when we are currently a lot in profit, because when the current price is above the realized price, we might consider maybe we take some of that profit, right? Maybe we use this for consumption, maybe we use this to allocate towards other asset classes, maybe the weighting within our portfolio of Bitcoin has grown that large that at some point we want to buy maybe stocks or gold for that, just in order to be somewhat protected. So whenever we are a lot above the realized price, it might make sense to sell, but definitely it makes sense to buy when we are below. Now currently, obviously, we are above. So on the macro scale, we are obviously not extremely cheap. We have to come down 50, 60, 70% from the all-time high to see real good buying opportunities. Now this is the macro. But most of us don't want to wait for the macro, right? Most of us don't want to wait 2, 3, 4, 5 years in order to find an entry opportunity. Most of us just want to trade more actively. And this can make sense. It's a bit harder though. We can apply the same psychological concept to the trading volume relative to the price. So when there was a lot of trading happening at a particular point in price, that's where currently the reference price short term is. And that's what we see in this chart. When there's a lot of red, it means many Bitcoin have changed hands at that point in time. When it's blue, very few Bitcoin have changed hands at the time. Now let's zoom in a little bit. What does this actually mean? Let's say you bought between the 70 and 60K range in Bitcoin, and now Bitcoin gets close to that range. You could consider buying still at that point because now you're getting back into your nice allocation area. But what happens once we fall below? If you have over allocated, you might suddenly panic sell because you've been in profit for so long. Suddenly you're in losses. You might want to panic sell. But when the first wave of selling happened under that support, then things can turn around. So a lot of trading volume at a particular price level tends to mark a potential support or resistance. In general, it's useful not just to look at the realized price over the entire lifespan of Bitcoin. That's useful for the macro. But for the micro, we can also look at the average cost basis of the short-term holders. And that's then this chart here. So we see the short-term holder cost basis in blue, and then we see 1 and 2 standard deviations away from this. So how much does the price fluctuate around that cost basis? And if you're short-term trading, if you like to trade Bitcoin And you don't have too many tax implications from this. It can make sense to buy whenever the price is close to the green level, and it makes sense to sell whenever we are close to the red level. Currently, we are slightly above the short-term holder cost basis, which is at 97K. People tend to realize profit and the market tends to heat up whenever prices are going up. When we then decline, things simply cool down. And at that point, when nobody is looking at Bitcoin, when there's very little realized profit, that's the time to buy in massively. Currently, of course, we are not there. We are not at a local peak. This is where it makes sense to sell, but we are definitely not at a historical bottom either. Over the years, crypto has grown more and more. And with that increased market cap also comes then reduced volatility, because it takes more and more capital to move the price. And so the price doesn't go that erratically up and down anymore. It tends to be a bit more muted. The volatility tends to go down. And so when we look at the relative realized profit and loss, we can see how both tend to go down, especially the profit. In percentage terms, the people that made money in crypto got lower and lower returns. But so did the realized losses, right? They're also becoming less and less severe. Are we going to see another wave of losses, as we saw in the past, every 4 years? Potentially, right? Nobody has a crystal ball. But things don't always go up. So we have to be at least mentally prepared, potentially also have set up our portfolio in a way that we always have some money outside of crypto that's not so much correlated. Maybe we own some gold, maybe we own some cash, maybe some property, something that we can sell to then allocate towards a crash in case we go below the realized price again. By the way, that realized price is now at 46K, but it is increasing constantly. Bitcoin is having a hard time going above the 111, 112K mark. And I think that's because the short-term holders are getting spooked. This is not selling by the long-term holders. Have a look at the realized profit by long-term holders and short-term holders. The long-term holders are in blue, the short-term holders are in red. And recently it was mainly the short-term holders that sold. And I believe that's because of this here. I like to show this pretty much in any video recently that discusses Bitcoin because it simply worked so well. We talked about this line before we got rejected twice. So those 3 retracements over here had all been predicted on this channel. Feel free to check out prior videos on this channel. I publish videos on alts, but also on Bitcoin regularly here. But yeah, when you're short-term trading and you just made nice gains of 50%, potentially with leverage even more, and you're seeing a chart like this, then it does make sense to take profit, right? At least partially. There's no surprise. But then it's always about long-term versus short-term. And the current price drivers are not necessarily only what the short-term holders are doing. The short-term holders sell short-term, but they're not going to sell forever. They will have at some point exhausted their selling, and then the long-term holders take over. Now, long-term, we see how money continues to flow into crypto, right? This is the stable coin market cap, and this is going up since October of 2023. Short-term though, there is a potential for more downward pressure because this is now the stable coin dominance. How much of all of crypto, relatively speaking, is in stable coins? And this tends to trade between 9% and 5% in the last 1.5 years. And if this is going up, if the stablecoin dominance is going up, that means crypto prices are going down. So the short-term holders have already started selling and they might sell a bit further, but at some point this will be exhausted. And then the long-term trend will take over. The inflows into crypto will take over. And it's not just the stablecoin creation, it's also the demand by the Bitcoin ETF. It's also the demand by all those new institutional investors like MicroStrategy and the other companies that are following this Bitcoin treasury strategy now. Here, have a look at this. Bitcoin treasury company balances. It took 4 years for those entities to acquire 1 million Bitcoin. And now within 1.5 years, they acquired another 1 million. So there's an acceleration in the acquisition of Bitcoin despite the price getting higher and higher. So it's not just that there's more money getting into crypto. It seems like the adoption by those entities is faster than the price increase. And that, of course, will push the price even higher. So while short term, there are still some holders that might get spooked because of that resistance, very long term, I believe that the resistance will get broken. We will get above 112K, and that's because of the Michael Saylors, etc. of this world. The demand is simply very constant. Those entities are scooping up more and more of the Bitcoin, and that's what's driving up the price. Now, to a degree, the crypto market is just a reflection reflection of unregulated life. As in, most gains come just to a few people, to a few assets. The vast majority tends to lose. So if you're just taking a broadly diversified portfolio of assets, we're likely going to not perform that well. Because here's the thing, crypto does not have any regulation. Everybody can launch a coin, and so there's no real barrier to entrance. And because of that, we tend to see a lot of fraud. We tend to see a lot of setups where tokenomics are rather poor, so where the average investor tends to not make money. And so when crypto cannot create money out of thin air, when it's actually a sophisticated system of moving money from the not so well informed to the better informed, then how can we become better informed over time? Because surely there's also a luck component involved, but there are some people that tend to win long term. Now, it's obviously not easy to become part of the minority. If we are not launching a project and we know more than the rest about that project, then how can we still become insiders? I think the best answer is to try to figure out what the insiders are doing and then simply copy trade them. For example, over here, we've got the Martini guy, and he bought the Chippy token when the market cap was still at $455,000. Now have a look at the comments on that wallet signal. The Martini guy tweeted about Chippy 2 hours after he has bought himself. And so since we are in a market without much regulation, and since we are in a market that does not produce any wealth, it's just transfer from one to another, it's all about figuring out an unfair advantage. And the unfair advantage of Martini guy is to simply have a following, right? He's just buying and then he tweets about it, and then the price goes up by more than 50% in just a few hours. Here's, by the way, his YouTube channel. He's got 150,000 subscribers. And so when we know what the insiders are doing, when we know what the influencers are doing, we can replicate those trades. Now, the art is in finding the right wallets. And we are tracking 12 wallets of Martini guy. In total, we are tracking more than 500 wallets. So 12 are by Martini guy, but we've got a lot of other influencers as well. For example, check out this signal over here. This is YouTuber Jesse Eckel. He bought $10,000 worth of the winner token on the 2nd of May. And surprise, surprise, on the 6th of May, he published a video about the winner token. And so, of course, the price also appreciates in the top by almost 50%. And so really, it's a game of attention. It's not a game of fundamental analysis. Most YouTubers, they simply just buy the asset and then they promote it on their channel. And then later on, they might sell it at a higher price. Don't get distracted by all the noise. We're also following Alex Becker, for example. So we've got 12 of his wallets. We are tracking Crypto Banter. We've got 33 of their wallets. And here we've got Brian Young, who, by the way, bought the virtual token extremely early. And we've got 5 of his wallets. So how do we get all of that data? How do we know what influencer holds what kind of wallet? And how can we then create those signals that we can actually buy and sell with them? The answer is through on-chain analytics. So there are several approaches. We can, for example, look at what kind of NFTs does somebody hold. We can then see, are there maybe potentially deposit addresses on centralized exchanges? Did other major deposits happen to the same kind of wallet? Are those wallets potentially connected? We can also look at prior purchase histories. So let's say we've got an influencer that talked about very small altcoins in their Twitter or in their YouTube. And then we look at wallets that held all of those altcoins and that potentially bought them also before the tweet or before the YouTube video. Then we've probably also got the right wallet. We can then afterwards confirm this, right? We can look at what is the wallet buying next. Is there again another tweet or another YouTube video on this? If the answer is yes, it's probably the right thing. We're then continuing to track it. And so I've made an entire video playlist on how to find different wallets and how to track them, how to then get the signals and how to interpret the signals. And so our entire community is trying to find new wallets, discussing this in the wallet research channel. And then once we found an agreement, we add this to our influencer trade tracking channel. And so the idea is pretty straightforward. We're trying to generate as much outperformance as possible that in the end, the membership more than pays for itself. Now there is some funds needed, right? We can't just trade with a few $100. I think the best portfolio has at least $5,000. Once you are at 5,000, you should be able to make that money back. Now, if your portfolio is larger, then you can consider to potentially sign up for yearly as well. First of all, there's a discount involved. So there's $250 off. But secondly, there's also a 1-hour free Zoom call. So in case you've got a larger portfolio in crypto, but also outside of crypto with other asset classes, and you could benefit from a direct one-on-one call, the yearly membership might be for you. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers!